Good afternoon. My name is Nick Fluellen. I'm a senior managing director with Millichap, and really excited to be here with you all today. This is our fourth webinar since the COVID-19 crisis began, and it's been a lot of fun for us to put these webinars on. The feedback that we have received has been overwhelmingly positive, and so we just thank you all for listening and sharing your thoughts with us after we put these on. And our hope is that these are not only great educational pieces for you guys, but also that they give you some good historical context and motivate you to keep growing your portfolio in multifamily. And so we are appreciative of the continued support on this front, and just really love hearing from you guys afterwards. So I would say too, we love to have those follow-up conversations as far as just thoughts that come to mind. I've had a couple of longtime clients that have reached out after some of our last couple of webinars and have said, hey, maybe I've been doing this wrong, and maybe I should reconsider some of the things that I thought were a great business plan. So it's a pretty cool thing that's come of this, and I would love to again have this conversation. So thanks for making time today. I think this is going to be a really enjoyable webinar. We've got my good friend John Griggs with us. We're going to spend the first part. So my good friend John Griggs is with us, and we're going to spend the first part talking to him, just learning a little bit more about his story, how he got to where he got today, his thoughts on the market today, and really just hear his take on how he's been able to evolve with his company over the years, and maybe even look into the crystal ball and see what the future holds. And then after we do that, we'll see if his crystal ball aligns with Greg Willett's crystal ball and Paul Hendershot's crystal ball. And they're also here with us today. Greg's the chief economist at RealPage, and Paul is the director of market analytics and DFW for CoStar. And then finally, Mr. James Ng will get on in a bit and give us a capital markets update and give us just kind of the latest and greatest that we can expect in the debt world today. And obviously, my good friend Paul Peebles will join in the second half of this call too, and lead the charge. So before we dive in with John, just want to let you all know that there is three little dots at the bottom of your screen. If you click on those, that will take you to the Q&A function. That is different than the chat function. So if you have any questions for any of our speakers today, click on that. My partner, Bart Hoover, is monitoring those questions as they come in. And at the end of our time with John, he'll pop on and pick a few questions and ask those to John. He'll do the same at the end of the call. So with that, let's get right to it. And again, joining us today is John Griggs. John is the co-CEO and co-founder of Presidium. And Presidium has a current portfolio of more than 13,000 units with a total asset value of more than $2 billion. In addition to the current holdings, Presidium over the last 15 years has sold or recapped more than 11,000 units and returned over $1 billion in capital back to investors with a blended IRR of around 40%. So spectacular metrics, no matter how you slice it. And then the newest evolution of Presidium, which has been really interesting to follow, and we'll talk a little bit about, is the new construction. And they have 7 deals currently under construction, 10 more in the pipeline, totaling over 5,500 units. So just an absolutely remarkable, mind-blowing number, and look forward to hearing more from John as far as how that happened. So, John, why don't you share with everyone what your background is and kind of how you initially got started in the real estate business?
Yeah, absolutely. And first of all, thanks for doing this. This is really fun, and these have been great events that you guys have been holding. So, it's interesting. I've been doing this longer than it feels like in some ways. It's been 17 years. Started out as a young guy. I thought I always wanted to be a lawyer. I love debate and politics and kind of analytical thought and that kind of stuff, and went to undergrad at Stanford and got a degree in political science, which actually meant I pretty much had to go to law school to get a job. So ended up going to law school at University of Michigan and graduated in 98 and worked in Los Angeles in the late 2000s. While I was at law school, I met a guy named Cross Mosheri. We knew each other a little bit, but ended up in offices next to each other at the law firm in LA. And we quickly figured out that we didn't really want to be lawyers long term. So just kind of started to think about entrepreneurial things we could do. Around 2000, I actually kind of took a little break from pursuing the entrepreneur thing and moved up to the Bay Area. I had a brilliant idea to move to the Bay Area in the .com era and to work at a law firm there and hopefully join a startup and make millions of dollars as a general counsel. That didn't happen. I got there in spring of 2000 at Wilson Sonsini up in Palo Alto, and the .com market cratered, and I was struggling to kind of stay afloat there and to keep my job. But it ended up not being a bad thing. The firm probably laid off 40% of its associates. I stuck around and did whatever work I could to stay relevant and ended up getting paid a decent wage and not being all that busy. I went from working 70 hours a week to 40 and had some spare time. So at that point, Cross and I really started to look at doing something entrepreneurial. And we figured that residential real estate was something we could jump into with the resources we had. So we looked all over California. He was in LA, I was in SF. We couldn't find really anything that made sense. He just needs so much money. And then looked in Arizona and thought, wow, this is actually a growing state. And, we can actually buy stuff here that we can afford. So we took about $100,000 and bought 8 fourplexes, levered them to the hilt. I would not advise anybody to take our financing strategy, and learn the business and spent 2 years kind of fixing them up and getting them serviceable. And what happened over that time that was interesting is rents didn't really go up there, but that market just went nuts. Tons of California money went in, and prices went up 70-80%. So we're sitting there 2 years into this. Oh, this is great. So we sold in 2005, made a great return, kind of a 5x type thing, and then started looking for the next real estate opportunity. And by that point, the housing bubble was getting a little scary. So California and Florida were a little nuts. Vegas and Phoenix were crazy. And we started looking around the Western US, and Texas really looked good, really for the same reasons it does today. I mean, kind of population growth, job growth, business friendly, all those things. And so we took the plunge and started making trips out to Dallas and found a deal that's a little over 100 units. And it was like the biggest piece of real estate we could imagine. It was $3.5 million. We raised a little over $1 million from friends and family. And it just seemed like unbelievably large in scale. And that was our first deal in 2005.
So with respect to that, tell us about the debt on that deal.
Yeah. So just got debt from a community bank that was kind of was actually Silver Gate Bank out of San Diego. I think they've been acquired, but and they kind of provided about 75% acquisition financing, and it worked out pretty well. We were total newbies, so it took a while for us to get there, to figure out how this stuff was financed. Back then it was a little bit less of a frothy market. We got extensions on our contract fairly easily. It didn't go hard on our earnest money for quite some time. I mean, really, I don't think we could have pulled that off in the same way today, but it worked out.
So with that first deal, the idea, you had a 5X in Phoenix, so you had a lot of money right there. Then you find this deal in Texas, you buy this deal, you're raising a little bit of money. Was the early strategy to get in and out of deals? How are you trying to establish your reputation and strategy in those early years?
Yeah, it was. I mean, it was essentially to go in to raise rents and hopefully surf a, kind of a value creation wave and exit or refi in the first few years. I mean, that continues to be a pretty good strategy.
Were you full-time real estate at this point, or were you still practicing law?
Yeah, so 2005, quit my job and full-time real estate when we bought our first deal.
So you come into DFW, you have this first deal under your belt. Tell us about the process of buying more deals, growing the portfolio, and obviously this is all right before the recession hit. So talk to us about how that all happened as you were just kind of getting the wind behind you.
Yeah, no, it was a pretty frenzied time. I mean, we were, after we bought our first deal, we thought that this is something that we really want to scale up and turn into a larger business. So started buying other assets kind of around DFW, moved into Houston, and built up a portfolio of about 5,000 units in the first 2 years. And we were just furiously kind of talking to debt and equity, talking to brokers, trying to asset manage our operations. It was a pretty frenetic time, and learn the business, kind of when you're running at 100 miles an hour.
And then initially, I know y'all had fee management. Maybe talk about that. You had a fee management company. You grew, I think, to close to 5,000 units, and then all of a sudden you guys said, okay, hey, Nate, maybe we need to take over this. So talk about that process.
Yep, exactly. So, we grew pretty quickly, and, we pulled the reins in kind of about a year before things really started to get hairy. And really largely because we grew so quickly, I felt like we needed to kind of take a break and focus on operations. And we just, third-party management, it's certainly, you need it it's useful when you're growing at a fast pace and when you don't have, more than a couple thousand units. But we got to a point where I thought we really needed to kind of focus on this and just streamline things and squeeze out, efficiencies. And I just wanted to have more control. I didn't want to be kind of looking in the rearview mirror. And we were just active. We were on site a lot. We were there all the time. And it turned out to be, in some ways, a really fortuitous thing. I mean, the recession hit and deal flow just, really went down to a shrivel. And we just spent 3 years just getting into the assets. And I was kind of the regional manager. I was doing loan draws. I mean, I've kind of done every task that our folks do at our company, and it's extremely valuable. In the recession, it was enormous because we were able to kind of to keep things going because we were so hands-on. But now, now that we have obviously a full team doing those things, I mean, we can really, no one's going to kind of pull wool over our eyes for the most part, right? With regard to a lot of those operational things, because we've done it. And I think for anyone getting into this business, whether you do third party or whether you do your own management company, I mean, you need to understand the operations at a ground level. Spend time at the sites, spend time with the people, learn how, all the parts intersect. It's really important.
So you guys, in that time, so you've got fourplexes. You now are in the multifamily business. You're now growing significantly. I know how a lot of the folks on this call, the early equity raises go, and so how maybe talk through. How did you go from buying a deal to all of a sudden getting enough equity and friends and family and other sources to buy that many deals?
Yeah, once you get momentum, these things kind of present themselves to you. So we started with friends and family, and we still have friends and family in a bunch of our deals, and then kind of started talking to some family offices, started talking to some private equity funds, and they, invested with us back then. There's a couple groups that we still invest with today. We've had really kind of long-term experiences. What's interesting is when, on the operator side, you're always thinking, gosh, it's so hard. I've got to find equity capital for my deals, and you're hunting for it. But the equity guys are hunting for it too. I mean, the vice president in New York who says, is charged with building out a Texas platform, he's looking for operators that are qualified. The small investor who wants to put $100,000 to work, or the family office that wants to find an operator, they're looking for people like us as well. So it's just something to think about. I mean, look for them and they'll look for you too.
So at that point in time, number one follow-up question on one of your comments, did you already do your own fee management before the recession, or did you do that as a result of the recession?
We started it right before. We started about a year before, which turned out to be great timing. And it just, there was no deal flow. So it was a time when you can really focus on it. And building a management company is not easy. It took a couple cycles to get the right people in the right seats. It's a very difficult thing to do. And if you're going to do it, someone on that founding principal team needs to really be devoted to it for a period of years, I'd say.
So you did the smaller deals and you got the C deals, as everybody generally does initially. at what point did you guys start saying, hey, let's start upping the quality of the portfolio? Let's get into some more B80s type stuff and even newer than that.
Yeah, we did that certainly before the downturn, and then coming out of the downturn, once the sky started to clear, it was 3 years of kind of scrambling to keep everything going, and it ended up coming out okay. And one day things kind of stopped getting worse, and we thought, let's get back into this. Let's start building kind of the next portfolio. And so in 12 we started to do that, and what really changed from kind of pre 08 to now is just the quality of the rehabs. And so, before, in the old days, $2,000-$3,000 a unit was pretty normal. After, 12, 13, 14, these things got a lot more elaborate. And I think that's a good thing, because when you take an asset 70s, 80s, even 90s, I mean, you need to put capital into this to make it serviceable. So we started to build out in 2012 kind of a full, kind of capital improvement team. And we would buy newer assets, but we would still buy older assets. But if we bought older assets, we'd put the money in day one to fix the stuff that was broken or that was going to break. And I think that's a critical thing for anybody in this business to do. If these assets don't heal themselves, they need money if there's problems with them.
Are you still buying conventional deals these days? I know you. Well, let's talk, I guess, about the development side first. So you guys obviously over time have said, okay, hey, look, we have this opportunity. So how did that come about? And obviously, how does that change the way you look at existing inventory today?
Yeah, no, that's great. So from 12 to 16, we went on a programmatic buying spree, kind of in all the major metros in Texas, and bought over 10,000 units, renovated them, and things were rolling. And it really made sense to be going great guns on this. We decided kind of as a separate vertical to do development about 5 or 6 years ago, and started to build out a development team and acquire sites. It felt like the next thing to do and the next kind of thing to graduate to. And it's just a fascinating, kind of endeavor, right? Something, I've always wanted to do since I started in this business. And it is, it's definitely an intellectual kind of driven kind of pursuit. It's a lot of work, but it's a lot of fun too. So we started building that up, and I just thought it would probably be kind of, we do rehabs and we would do development. And over the last couple of years, things are just a lot more expensive on the existing asset side. And if you can actually do a development, and it's extremely capital intensive, it's in some ways it's harder than doing value add, because you need to have a development team, which is payroll. You need to spend money generally before your partners are going to be coming in. To get a development off the ground, I'd say rule of thumb is plan on spending $1 million on architects, engineers, all the stuff you need to get to shovel ready. So, as the operator, you're responsible for that in most cases. So that's the hard part. And there's obviously risk. There's risk that you're building something that, you're projecting a market kind of 3 or 4 years out. The upside, though, is when you're building an asset, you're looking at today. If I build something, call it 150, 160,000 a unit in DFW. If I snap my fingers, build that thing and lease it up, it would sell right now for 190 to 200. I mean, just in some of the markets we're in. So there's a really nice embedded margin there. But the obvious problem is you're not snapping your fingers. You're projecting into a market 4 years out, and you're putting up a lot of capital before you actually start the vertical construction. So there's risks and there's opportunities.
So are you guys still doing conventional deals today? Or are you still looking for opportunities on that front? Or are you pretty much just focused on the new construction at this point?
We would absolutely do value add, more of it. And we still have a large portfolio of 13,000 units that a lot of them are covered land plays at this point. But we, if there's an opportunity, if there was ever kind of a hiccup in pricing, which I thought might happen with this, and it looks like it's maybe not happening, we would be in great guts because we have the team to do it. I mean, we could gulp 5,000 units in a year and go just full speed ahead on rehab. And it's a great business if you do it right. You're returning capital inside of 18 months. The returns can be spectacular. So no, I love it, and we would do it. But kind of where we are now, we've built 2 deals that have been leased up, and 350 in Austin, 350 in Jacksonville. We have 2 that we're about to deliver, 270 in Pflugerville near Austin, 200 in Frisco near Dallas, and we've got 3 under construction, 400 in North Fort Worth, 370 in Jacksonville, and another 370 in San Antonio near the Rim. And hopefully we're probably about to break ground on 2 more, one in Dallas, one in Austin in the next kind of 3 to 4 months. And we have, kind of a pipeline behind that we're actively programming.
Well, I don't know how you sleep at night. It sounds like you need all 24 hours in the day to get this stuff done. But so we've talked a little bit about some of the highlights, obviously, and those are exciting to talk about. But over the years with the recession and just as you guys have evolved, I'm sure there's been some challenges. So maybe touch on some mistakes that you guys made or some things that you would go back and do a little bit differently in maybe the earlier days.
Yeah, absolutely. And we're constantly learning. I mean, there's always things you learn. I think the one thing I think that's really relevant for folks in the value add space, go in with all the capital you need for your renovations. I mean, that's something that I would say is paramount. And if you have to, you're always going to have to squeeze something to get to the number, especially if you're dealing with quality brokers like Nick and Bard who get the top price. You're going to have to squeeze your underwriting. The one thing I'd say, don't squeeze your capital budget. Don't do it. If you're looking at a chiller property and people are complaining it's hot in the summer, don't budget $50,000 a year for chiller repairs. Figure out the problem and go in and get it done. And then also have some reserves. I mean, plan to have 1 or 2 months of expenses just sitting there. Don't over distribute and then kind of put yourself behind the wall. So that's a critical thing on the financial side. And then one just thing that's more of just kind of a communication thing is, and this is hard for everybody because we're in this because we're optimists, right? We think tomorrow is going to be better than today. But when things are difficult, talk to your investors. Tell them what's going on. Number one, they're smart people. They probably already know that if there's kind of a greater economic issue, they're aware of it. So let them know how that's impacting your asset. But don't hide the bad news. Tell them what's going on and give them a heads up that if there's not going to be distributions 3 months from now, yeah, maybe tell them now. And people appreciate that. They really do. They appreciate the honesty.
Yeah, I think that's great advice. Both of those pieces, I think, are really, really good advice for right now. And obviously, the people have had to get good at maybe delivering some not as pleasant news here recently in light of some of the uncertainty in the market. Though obviously, we've done better than we expected. So, with that, since you own so many conventional deals, let's talk COVID crisis and operations. So. Maybe start with how was May across the portfolio from a collections and leasing standpoint?
Yeah, so we were down about 5% in collections in April. In May, we were up about 3%, and this month we're tracking up again. So I think it was David Moore on a previous webinar said if you looked at our operating statements, you wouldn't know that there had been this massive calamity, and that's really true. So we're fortunate. It still makes me very nervous because it's somewhat artificial, propped up by enhanced unemployment benefits and other kind of goodies that are keeping people flush. But I'm getting, I think we are seeing the skies to brighten a little bit. And I think, especially in Texas, you're going to see the economy get better again.
Did you guys halt distributions on your deals?
We did, yeah. And we're looking at restarting them probably in the next month or two. On some assets, yeah. And
so if you were looking ahead for the rest of 2020, what's your crystal ball say in terms of operations? If you had a gut feeling, I know everybody's a little nervous when stimulus money runs out and enhanced unemployment, but what's your take?
Yeah, I mean, I think, because it's an election year, I don't think it's in anyone's political interest to create poverty. So I have a feeling, I'm pretty sure there's going to be an extension of benefits. I don't know if it's going to be the full boat, but people are going to be kept afloat. And then you're actually starting to see the gears engage a little bit more in Texas. People are getting back to work. Traffic on the freeways is picking up. You're seeing people out and about. And interestingly, you're starting to hear whispers of the kind of big announcements that fueled this before. I mean, Tesla, it's no secret, is looking at Austin as a HQ2 or relo. You've got, Facebook announced they're probably hiring 1,000 people in Dallas. The couple million square feet of new industrial announced in Alliance where we're building something. I mean, these kind of things that used to be every week, they're starting to pick back up again. So the tailwinds for Texas are just enormous. And I think it's only going to get better.
So a lot of times I mean, obviously this is a unprecedented time in terms of the global impact of what we've been dealing with. But a lot of times when you have uncertainty in the market or a recession, people freeze and they want to wait and they're uncertain. And I guess I'd love to hear just some brief comments on what is your attitude or mentality when it comes to acquisitions in the marketplace right now. And, is this, you talked about, hey, maybe there's not as much of a deep discount, which I think is true. The values aren't really affected a ton right now, but what kind of mindset do you have, and do you think people should have as they're potentially considering opportunities right now?
Yeah, I mean, I think you definitely need to be cautious. It's not, there is still uncertainty in the market, and things are a little bit in flux. But to the extent you find an asset you like, I wouldn't be afraid to go out and buy it right now. With the right business plan. I think it's probably the other thing is interest rates are down, and I think they're going to go down even further. The rates are all in kind of around a 3, but that's with a pretty big spread. That spread's going to come in, and then that could actually add some fuel to the fire.
Yeah, so talk about what's next for Presidium. You guys have done it all, fourplexes, B, C, A, new construction. We talked briefly about you guys creating a fund. Maybe touch on the creation of the fund.
Yeah, no, absolutely. So we are partnering with Thomas Title, which is headed and founded by my good friend Frank Bush. Presidium and Thomas are coming together to form a fund called Deloach Capital. We're actively in fundraising mode right now, and we think this is a unique offering. It marries up Frank's deal flow, which is enormous. He does about $5 billion a year in closings at Thomas Title, and our operational expertise. And essentially, what we're looking to do is find opportunities on the sponsor side, where sponsors need some capital to get their deal done, whether it's because a debt quote kind of came in short, equity came in short. They need kind of that last $1 million to get over the finish line. And we could provide essentially preferred equity or even common equity. It's all up in the air, kind of how that's structured. But what we're looking for is quality sponsors, quality real estate, and good structures that make sense for us. And the deal flow that Thomas Title has, married up with the operational expertise the Presidium has, I think is a great program to find these sponsor side opportunities, whether it's at acquisition or if there's a later event, like if, for instance, if this crisis kind of takes a turn and gets a little worse, and an operator needs $500,000 or $1 million in preferred equity to bridge the gap. That's the kind of opportunity we're looking for. We can come in and not look for control, not look to take over someone's deal, but to provide equity and get a decent return on it. So we're actively fundraising from, we're talking a bunch of family offices, but also, open to individual investors as well. It's, we're looking forward to it.
That's awesome. Yeah, it sounds like a really good opportunity. So last question, then I'm going to cut to Bart here for just one or two quick questions from the crowd. But 15, 17 years ago, you were really not much different than most of the people on the call. And in fact, some of the people on this call were further along than you guys were at that point in time. And obviously, you guys have been able to parlay that into a tremendous amount of success. And so, congratulations on that. It's really spectacular. What's one piece of actionable advice that you would give folks tuned in today as they look to grow their multifamily business portfolio in the coming years? And maybe it's just motivation of, hey, I didn't think I could do this, and here we are, or what? But what's one thing you would just share as a takeaway for the folks listening in?
Yeah, no, that's good. Obviously there's kind of the things that are pretty basic. Hard work. You got to work hard. You got to be honest. You got to be in the community and kind of have good relationships. But I'd say one thing that's important is, become an expert in your area, in your submarket, in the area that you're looking to be a leader in. We happen to be in Texas where things are great. If you're in Dallas Fort Worth, huge sandbox, 750,000 units, you can do very well there. Be an expert though. Your investors are going to look to you as the expert who knows where to go, how to operate, and how to make money. And so, get in deep. don't spread yourself too thin, I would say. I mean, certainly you'll at some point as you grow a portfolio, you'll want to expand geographies. But, I would say when you're starting out, try to focus on one or two metro areas and, build out a portfolio and then kind of wade in. You don't want to have too many kind of irons in the fire geographically when you're growing.
Yeah, I think that's great. Great piece of advice. Bard, why don't you hop on and ask John a question or two that you received during this time?
Well, I've got about 15, so I'll try to narrow it down to a couple. John, thanks again for coming on, man. Really appreciate it. A lot of people are asking about equity. I mean, you built up 5,000 units so quickly. You started with friends and family offices, and then how did you raise that much equity that quickly when you were newbies, basically, back in 2005?
Yeah, I mean, it's funny. People talk about the last run up as, a crazy frothy time in real estate. It was nothing compared to 5 and 6. I mean, there was so much money chasing real estate then that it was really possible to kind of go to groups really early in your real estate career. I mean, it's harder now, but that said, it's not impossible. I mean, it's networking is important. Kind of tapping your personal networks, professional networks, people you went to college with, all that is key. And just keep getting out there. Get out there in the community. Talk to people. Go to lunch. Go to conferences. Do all that stuff, and you'll find people because they're looking for you too.
Okay, cool. Thanks. What about pricing expectations? So you mentioned you're bringing a deal in Jacksonville to market here coming up. Have you modified your pricing expectations on that deal at all? And have you seen cap rates move through this pandemic? And where do you see cap rates going over the next 12 months?
Yeah, it's interesting. The answer is no. We've not changed our pricing expectations. And there's been a couple data points that are pretty recent that Class A deals actually in Florida and in Texas are kind of getting put under contract within 1 or 2% of pre-COVID. So I am, this is not a fire sale, and if we don't hit the mark, we'll refi. But I don't think this is, we're not expecting that. As far as cap rates, it's interesting. I think we were joking before. I was on a flight to Munich with a number of these guys for Oktoberfest last year. Coincidentally, I was meeting some college friends. They were doing something. I was hanging out with a guy at Oktoberfest who's a big office guy in Munich. And I said, what are interest rates over here? And he's like, I just kind of locked one at 0.65. We're battling between 0.65 and 0.75. And I said, now, is that a spread over some reference rate? He said, no, that's the coupon. That's the coupon. They have negative interest rates, right? To the tune of negative 25 or negative 50. But they've had it for so long, and rates have been so low for so long that the spreads have come in and they're getting rates on commercial real estate under 1%. I don't know if that's going to happen here or not. I tend to think it won't go that far. But the longer rates stay low, the longer the 10-year stays low, the longer LIBOR stays low, investor expectations for rates are going to come in, I think. So you could be in a situation where the rate today from Fannie and Freddie that might be a 3 handle or 3.25, 275, something like that. I mean, that could come into 2.5, 2.25, and that just changes the economics for everything. So I think there's a case to be made that cap rates do compress. The other thing I'd say just very quickly is other asset classes I am not very bullish on. I mean, hospitality, retail, even office, it's going to be a tough road for a long time. And real estate funds have raised a lot of money, and they're paid to put it to work. So where are they going to put it to work? Probably in multifamily, because that's the one that still works. So who knows? But there is definitely a case to be made that there is a real leg up for multi in the next few years.
We happen to agree with you on that one.
I wonder why.
Yeah, we're not biased at all. What about rent growth? How have you modified your rent growth projections both on your existing value add deals and on your new construction deals?
It's TBD for this year. This year we're going to kind of throw it out. I mean, I think it might be flat this year. Frankly, that with everything going on, I'd be sort of feel good about that. But yeah, look, I think going forward, rent growth's going to return. I don't know that it's going to be the furious pace it was the last few years, but we're going to see kind of a 6-month real decline in starts, which means there's going to be a window, a year and a half from now where deliveries are going to be way less. So, Austin at 10,000, DFW at 20, 25. I think those numbers probably get cut in half for 2021 or probably 2022 deliveries, and that helps the demand side by reducing the supply side. So, I'm optimistic on rents.
All right, Bart, one more.
Okay, one more. What was the name of that first 100 unit deal you bought at DFW? See if you remember.
Oaklawn Heights. We sold it in March, 2 weeks before the pandemic.
Oh yeah, right on the toll road. I know the deal.
Exactly right.
Yep.
Kevin Parrish bought it.
Yep, that's right. Thank you, John. I appreciate you answering all those questions. I've got a dozen more, but we don't have more time.
Yeah.
Appreciate it, man.
All good.
Awesome. Thank you, John. So, Paul, I'm going to turn it over to you, and you can get the second part of our presentation started. And one thing I'll add beforehand is we are recording this for people that joined in late. And so if you missed the first part of John's comments, we will have that out in the next couple of days here. So don't worry about it. So with that, Paul, I'm going to turn it over to you.
Sounds great, Nick. I appreciate that. What great information from John Griggs. Him and his partner Cross have done a fantastic job building stuff all over the United States. Starting off a little bit just how you guys did, single family, duplexes, fourplexes, your Class C properties, now building properties down in areas like Austin. So I'll say it just like how John's neighbor says it down in Austin. All right. So next up are the smart guys in real estate, and Greg Willett and Paul Hendershot. And so Greg, as you know, is chief economist for RealPage. Paul's director of market analytics for CoStar and DFW. So you cannot pick up a magazine or read a newspaper article that talks about apartments and real estate without one of these guys being quoted. So commercial real estate brokers, apartment builders, investors, and bankers all listen to these two guys. They're going to give you some insight on what's happening in apartments today and what they envision for tomorrow. Each will speak for about 10 minutes, and then afterwards we'll take some questions. Remember to ask your questions in the Q&A portion of the screen, and Bard will ask those at the end. So first up, we're going to have Greg Willett with RealPage. So Greg, if you're up, let's get going on you. So Greg's up.
So good to join everybody today. I'm going to talk a little bit about what we're seeing in the marketplace. Actually, I'm going to echo some of what John said on the operations side. And I thought I would actually just start us off with some good news, some things we're really happy to see. So let's go to the next slide. And I'm going to start us off with some good news here. Nick, are you operating? There we go. So some things that we're happy to see. I think John was talking about on the operations side, and certainly from the operators, one of the first things you were immediately concerned about is, hey, I just want to protect the rent roll that I got. So you want to hold on to your existing renters, and certainly that has happened across the country. We've seen resident retention when initial leases come up for expiration. It is at new record levels. For the country as a whole, over the last couple of years, that retention rate had been running around 53% or so. In the past couple of months, it's gone up to 58, 59%. So people are staying in place. Obviously, if they're going to stay in place, you want them to be paying their rent. And as was alluded to already today, these rent payment numbers have come in, I think, above where a lot of people were expecting, helped by those enhanced unemployment benefits. So there is some concern about what happens as we move on down the road. But right now, as we look across the country, rent collections are only running, let's say, 1% to 3% under what would be the normal rate. So those are some very solid results. And then one more item to talk about is demand. And so as the world started falling apart in the last half of March and on into early April, demand that we were seeing was running at its worst. It got to minus 46% relative to the year ago volume. And we can look at the actual number of leases that are being signed through our property management software. So a big loss. And so we started filling in that hole as we got into the last half of April and then on into early May. And then the last couple of weeks in May, for the first time, leasing activity actually exceeded what we saw a year ago. So some good overall numbers for May on the demand side. We do have to keep in mind, though, there are some challenges that are ahead for us, and there is some market softening that's already showing up. If you look at occupancy rate, we are currently at, for the U.S. as a whole, 95.2%. It's a pretty healthy number overall, certainly by long-term standards, but we have backed up over the course of the last couple of months, and now we are off year over year by about 80 basis points. And certainly there's been some softening in the rent numbers as well. If you look at effective asking rents, which are really what would be out there on internet listing services, or what you would be told if you call the property and ask what the rents are, and also factor in the concessions that are being offered there. Those are off a little bit, but again, via the property management software, we can see what the leases are actually being signed at. And in a lot of places, these executed leases are much lower than the asking rents at this point. Go on to the next slide. And so for in May, for the country as a whole, these executed lease rents were down about 3.8% relative to what we saw a year ago. It varies a lot by market. There are a handful of places where rents are still going up a little bit. A lot of markets are essentially flat year over year, and that includes most of the Texas markets. But look over toward the right side of this graphic, and you can see places on the West Coast and these gateway markets where rents are down at double-digit levels. So some pretty sizable rent cuts in some of those locations. And the place you don't want to be right now is where John started his career, Bay Area, really taking down the rents very quickly, and also seeing some pretty significant loss in occupancy in those markets as well. One other point I want to make as we move ahead that I think is going to be challenging is we've still got a lot of product that's under construction that we're going to have to digest along the way. About 600,000 market rate units still under construction. Dallas-Fort Worth and DC, the leaders in building activity by a pretty big margin, but a lot of places have some significant product on the way. I was thinking that we were going to get a meaningful break in discussion, but John's going to keep building. So we will see how much it actually slows down once we get past this wave of completions.
So what the distressed assets coming to the market that we've all been hoping for?
I'm going to agree with John that they're not coming to the market. There will be a little bit of a price correction, but it's not going to be much. And certainly in Sunbelt, I think it's probably not at all, given the amount of money that's chasing deals. If you're urban core in a gateway market, yes, there actually can be some price correction that's on the way. But I think for the typical asset in the Sun Belt, not much movement there.
Anything to be concerned about when the unemployment benefits run out, what that's going to do to collections?
I will say a good signal is that if you look at some reporting from some of the consumer banks, and I'll particularly cite Bank of America, they have said that households that tend to hold small balances in their checking accounts, that they've run those up in the past couple of months. So people are clearly banking some of those enhanced unemployment payments to deal with at a future time. So I wouldn't be surprised, frankly, if we're still okay for a couple of months after the unemployment payments, the bigger unemployment payments run out. But somewhere on down the line, yes, it is going to get more challenging, and it's going to get more challenging in that Class C space, especially, and in some of those small deals where they're very dependent on cash flow.
Let me throw the microphone over to Paul Hendershot with CoStar. Paul, I'll let you take it from here. Paul has a little bit of a presentation here for you. Nick?
Okay. And great job, everyone. This has been a wonderful presentation so far. I'm learning quite a bit. I'd like to thank everyone for taking time out of their busy days to learn about the apartment market. So I want to say a couple things. Looking at I cover all four major food groups, and it truly is the multifamily or apartment market is the most dynamic in my opinion, because due to the fact that people are voting with their feet, they have shorter leases, they can change leases and basically move. And in terms of the comparison to the industrial market, it's definitely just been on fire even throughout this pandemic. I would say office is kind of a push. They're in a true pause at this time. And really the retail is, just been a bloodbath, and we can talk about that a little bit later. So let's go ahead and get started with the content. Okay, so one thing I have been watching is just, we'll go through a few slides just in terms of Texas economic activity and what we're seeing in DFW. One thing I am concerned with is the sales taxes. Many metropolitan areas, including Houston, for example, 25% of their revenue is from sales taxes due to the fact that we do not have an income tax. Now, there has been reform legislation to cap the increases at 3.5%, but if there is a disaster, that can increase to 8%. And we're already seeing some grumblings in terms of reassessing values, and that will definitely have a major impact on the commercial real estate community. So this is something that we are tracking, and I advise everyone to get ready to basically contest their appraised values in the near future. Next slide. Now, this is, why my colleague Greg started out with some positive news. I'll just get the bad stuff out of the way. Well, we've just seen the increase in number of unemployed in DFW has been staggering, to put it mildly. Just to give you a frame of reference, in 2019, we have a labor force of about 4 million people in Dallas-Fort Worth, unemployment 3.9. The average number of unemployed has averaged about 129,000, throughout 2019. Starting the number has now jumped to over 470,000 people are currently out of work. And we can dig a little bit deeper to see who has lost their jobs most recently. And it really comes to no surprise, leisure and hospitality is really taking it on the chin. 146,000 job losses, followed by professional and business services and education and health services. Keep in mind, Dallas-Fort Worth is a very diverse economy, and we are riding this out a lot better than other metros I work in and do this presentation. I work in Oklahoma City as well, and that one is really just getting hurt by the price of oil. Tulsa is the same story. So Dallas-Fort Worth, I believe, will be the last ones in, the first ones out in terms of the pandemic. And we're seeing, as Greg and other folks have alluded, has mentioned, we are seeing the economy open up. We are seeing things move in the right direction. I'm not here to make any medical prognostications, but we are turning the corner and things are starting to thaw. Next slide. Now, first I want to get into our daily asking rent series. And this is something we track in all of our asset types, office, retail, and multifamily. Looking at the comparison the last couple of years, and really this is a true measurement of sentiment among apartment operators. And we from several management, including Yardi, LOR, and along with our imputed data from our research team. And quite frankly, while we took a hit in about week 11, 12, that's when we first saw that punch from Mike Tyson regarding the pandemic, things have begun to level off. And this is indicative of our base case scenario. Things are beginning to stabilize, but rents in the urban core may continue to be impacted, but daily rents are flattening out and heading in the right direction. The next is looking at some of the apartment search data from our friends at apartments.com that CoStar acquired last year. And I can only show how the searches have behaved since the economic outlook. They began to taper off in mid-March for about a week, but since then we saw our searches increase from 40 million to 70 million. Now, how does this translate into leasing? Time will tell, but we're essentially digging a little deeper in the data, and there's folks looking to move. A lot of these searches are not just within a market, but folks looking to move maybe from Cleveland, Detroit, some parts of Western New York to southern markets as they reassess their economic situation. In addition to that, we're seeing two types of folks searching. First would be that person who's kept their job, the professional who's working from home, has a roommate and wants to either move into a bigger space or essentially get away from their roommate. The second side of the equation is the other half of the equation is really that person who is looking to couple up, roommate up, and their financial situation may be a little bit more precarious. So the bottom line is if you do have apartment for, I guess, if you're advertising an apartment, people are searching for space right now. Next slide. And in terms of concessions, these are looking at the existing properties and new properties are those that are in either lease up or basically less than a year old. And through May, over 60% of the new properties are offering concessions. About 40% of existing properties are offering concessions. And they really do vary by submarket and class. For example, Trammell Crow's Alexan on Lower Greenville, that was completed last year. They have concessions ranging from 12 to 16%. That translates to about 3 to 4 weeks free. On the other side of the spectrum, we have Amalie at the Fountain Place. They are really one of the higher end apartments in Dallas, recent construction, over $3 a square foot, $2,100 for a 600 square foot place. And they're offering, if you are a first responder or in the medical field, waiving application fees and deposits about $500 off. So next, let's dive into construction a little bit deeper. And here we have on the y-axis the number of units under construction, and the x-axis is the percent of inventory that's under construction. And the size of the circle is the number of units under construction. And it really is, as the previous presenters discussed, Dallas-Fort Worth has a tremendous amount of supply coming online, and that is not a red flag, but it's something to be concerned with within this market. And in total, we're at about 4% of our total inventory. Farmers Branch Addison continues to lead the metropolitan area with construction over 3,000 units. Pretty much everywhere in Collin County, Allen McKinney is up there as well. Downtown Dallas, you'll notice a kind of anomaly way to the far right. It's rapidly growing. They've enjoyed renewed interest. The Amalie Fountain Place, 1401 Elm should be wrapping up, now called the National, has a multifamily component, along with around the Farmers Quarter and the Farmers Market in East Quarter as well. And also I wanted to let you know, we do, so project is deemed under construction when the cement has been poured. And we track a lot of different types of assets, and we do this for consistency. Looking at the sales, deal volume was $5.8 billion in 2019. First quarter 2020 landed at $652 million. Q2, we've had about $66 million in sales. So, we have a little bit catching up to do in the next month, but the market is beginning to thaw. And I think underwriting is taking place. I think folks just were on hit the pause button, for lack of a better way to describe it, the last couple months. In terms of our sales by month, number of transactions between 2019 and 2020, we were a decent start to the year in January, but again, we see this begin to taper, about 74% down 74% April through May in 2020 compared to 2019. By geography, deals are fairly spread out. The mid-cities, Arlington, taking up a lot of the value-add the lion's share of those type of plays. Irving, HEB, for example, as well. And also the deals are finding their way to those northern suburbs of Plano and Frisco that have really just are continuing to grow. Demographics is definitely on their side. The prices for 2020 are skewed towards the value add. Prices pre-pandemic topped out about 138,000 units, and we were well on our way to breaking that $140,000 unit threshold. But based on the prices we report in 2020, there's been more sales on the mid to that mid-tier product. And there's a lot of price distortion out there right now. Buyers are interested in chasing deals, but there's quite a bit of reluctancy to sell at lower prices. And quite frankly, the valuations may be a little murky in general. But the rents, as we stated earlier, the rents have been holding up, and the CARES Act continues to keep this thing moving in the right direction. So let's just wrap this up with our more or less what we see the next year. In terms, this is our base case scenario, most likely case scenario based on the data. We are expected to see a bit of a slowdown. Quarterly, we may have negative net demand for a few quarters. But in 2020, we have 18,400 units delivered, and we're right on track really for that to happen. But we are seeing a bit of that vacancy just because we have so much supply, and we're not out of the woods yet. And that's really what our forecasts are reflecting. Unemployment right now in our base case forecast for employment, we're expected to lose about 660,000 jobs in Q2 and basically ramp those up through 2021 through the third and fourth quarters. And so this will adversely affect the multifamily market in the short term. With that being said, we expect 2021, 2022 to be back on track. It does change. We have changes pretty much every week as new data has become available, but that's our latest and greatest. So again, thank everyone for taking the time. And if you have any questions, feel free.
Yeah, you are an economist, so 50% of the stuff you say is going to be wrong anyway. So just one question before we let you go, Paul. You cover Oklahoma City and Tulsa, and some of these areas have a lot of natural gas and oil. Similar to, I would think, Houston. Houston is a big oil and gas town, production, distribution, pipe. What do you think? What's a multifamily apartments look like in Houston with the low oil prices?
In Houston, they're not going to be as hard hit as Oklahoma or a Tulsa because due to the fact they have I would say they have a more diverse economy. They have a large medical activity along with transportation and logistics that should help bolster those compared to the folks up in Oklahoma. Overall, in terms of the multifamily market, we are seeing the same forecast very similar to Dallas-Fort Worth due to the fact that they have diversified their economy. But the fact of the matter is they are going to be hit in the short term with the price of oil. But overall, they should fare somewhere, if I were betting, not as good as Dallas, better than Oklahoma City. Gotcha.
All right, let's turn it over to James and give us a little bit of update on the capital markets. I'm going to throw it over to James. James, what's going on out there, the professor?
Yeah, thanks. So the first slide here, touch on CMBS. On the top left, you can really see on the multifamily side, they saw a slight uptick, from 2% to 3% on the delinquency in May, but the big ones were in hotel and retail, going up to 19% and 10%. So essentially those people missed their first payment in April. And then you can also see on the conduit spreads, you can see that the triple B spreads are still very high on the CMBS side the last couple of weeks. And then, all right, so Fannie Mae puts out their forbearance stats every week pretty much. And, when we started this in April, they had about 29 loans, in about 373 million. And then right now it's essentially doubled every week. And so now it's up to 229 loans as of last week. And so those are all loans that Fannie Mae has in forbearance. They don't really give us a ton of detail. So I wanted to flip over to the Freddie Mac side. So next slide, Freddie Mac only puts this out on a monthly basis. There's about 1,000 loans in forbearance, which is up from 327 in April. And 75% of Freddie's loans are small balance loans that are in forbearance. And the reasons they're citing are, these are just smaller deals, mostly 50 to 100 units. They're more B and C class versus the conventional A and B. And a lot of the tenant base is more hourly workers. And so a lot of the closures that hit, in the leisure side, hospitality side, that was their tenant base. And so they see about 6.4 billion of their loans are in forbearance right now. and then 20% are either student housing or senior housing. And so I thought that was pretty interesting. On the next slide, it's that since our last call, Freddie Mac Conventional, they have started back on their locks. And so you can do index locks, spread locks still, which they had suspended for a while there. And Fannie is still not allowing you to do the streamline rate lock. And also on the Freddie side, they made sure that if you do disclose that you are currently in forbearance or ever in forbearance, they are making you, they essentially have a checkbox on all their Freddie SBL forms now. So just make sure that if you do decide to take forbearance, that you will be checking that. All right, and just quick update on rates on the left-hand side. Fannie, they're still having these index floors. The 10-year is at 90 basis points on their index floor, and then so the all-in rates, the low threes. On the Freddie side, you're probably mid threes to high low fours. And then this came out also on sort of the life company and CMBS side. Apartments and industrial are really the only things that they're quoting right now. Retail and hospitality are really on hold. And then this slide, you can take a picture of this slide. This really goes into the reserves. And this, I think, is what these out. They haven't really changed them at all. Fannie is 12 months P&I, taxes, insurance, and replacement reserves over $6 million. And then if you drop below $6 million, it's 18 months P&I. And they have a 6-month waiting period, and then it's released after 2 consecutive quarters. So minimum of 12 months. And, this is probably the thing that's holding up most deals right now. So we're seeing a lot of deals just sort of go assumption with no supplemental, and then you're able to do the deal without any reserves. They have not given us any guidance on when these are going to be released. And then let's go to the next slide. This is on Freddie. So Freddie had a little bit shorter of a window. So they had 12 months P&I on the SBL side. And they said, after all these declarations are lifted for 90 days, and then you hit 3 consecutive months of essentially 80% collection and your debt service coverage that you sized the loan at, you'd be released. Now they updated that just in the last week, saying that if in your state or for some reason it's not released, the 12 months after your first payment date, they will review your occupancy and your collections. And so I think that's sort of the outside date is 12 months. And then hopefully start seeing some of these reserves released after 90 days after the federal, state, and emergency declarations are out. And so that is your capital markets update.
Awesome. Thank you, James. I also just feel like I need to say that you have one of the best quarantine haircuts I've seen so far. So that's the beach hair. So anyway, I appreciate it. And really, just as we close things up here, we got time for maybe a couple of questions, Bard, if you want to hop on, and then we'll kind of shut it down here. So Bard, you want to hop back on?
Yeah, you've got a couple of questions for anybody. How has single family demand been affected from the pandemic and the recent appreciation news that we've heard on that? And what result will that have on multifamily? Is that going to be a positive thing for multifamily over the next 12 to 24 months?
So we have seen sales activity on the single family side hold up a little better than maybe some folks were anticipating. But in the big picture, I'm not worried about losing renters to single family. I think, we got lots bigger problems than that.
Okay. Do you see rent control? There's kind of a movement for rent control in Texas. Do you see that ever coming to fruition in Texas?
No.
I'll jump in and say it'll get discussed a lot in Austin, but it's not happening anywhere.
Yeah, I agree. I mean, it's not going to happen anytime soon. We'll have an income tax before that happens.
Okay, so as we've seen with the lack of rent collections on both coasts being at the highest percentages in the country, and it just seems like it just continues to be more of a mess on both coasts in many regards. Do you see our population growth here in Texas even getting better than it has been?
Yes. The long story short is it's just become so unaffordable to live in these places. If you're a young person starting out in their career, I mean, it used to be, that was where you'd go make it more or less. and it's almost it's becoming unaffordable. Like as someone who personally lived out on the West Coast for a while in San Diego, it's almost impossible. So I definitely think people are reevaluating, and I think we are looking at the way we spend money, the way we save money, the way we're valuing our time. And I think part of that will be folks are going to look at affordable options, and Texas will benefit. Places like Charlotte may benefit as well, along with Phoenix. But definitely Texas will benefit from this. We have been.
I actually want to have John Griggs answer a question for me. John, are you guys, with all this craziness about people not returning back to offices, on your new construction deals, are you guys reassembling or rethinking offices like a WeWorks inside some of these developments that you guys are building, or reconfiguring some of the work areas of your buildings?
We are, yeah. So we're looking at kind of office suites and in kind of common areas that people can use. We're also looking. I mean, we're going to do on future developments kind of touchless entry, that kind of thing. I mean, it's for the foreseeable future going to be part of the reality. So,
John, what about even a little office space inside of the units? Are you modifying the interiors any to accommodate maybe a little office?
Yeah, I mean, we're building in kind of more like just a kind of a cut in where you can kind of put a desk and a computer, maybe not a full room, but just sort of a built-in kind of desk type thing. Yeah. Yep. We're looking at that as well.
All right, guys. Well, like I said, we have such good folks on this webinar today. We could sit here and talk about this all day. And I just, on behalf of Marcus and Millichap and Fluell and Hoover Multifamily and Old Capital, we really, really thank you guys for joining us. We know there's a lot going on right now. And, John, we go back to the very early days of Presidium, and I'm real thankful for our friendship and appreciate you hopping on here with us. Paul, Greg, you guys are awesome. We are really grateful for your time and just keeping everybody informed. James, thanks for vacationing, but still hopping on and making time to keep us informed. I assume you're vacationing. I don't know why else anybody would be in Florida right now. And for everybody that's still on the call right now, again, replay will be available soon. We appreciate it. We would love to have further conversations about some of the topics we talked about today. If new ideas have popped into your mind as a result of some stuff you've heard, we'd love to kind of strategize with you about that. We hope everyone is staying safe and healthy, and best wishes for a great June and rest of 2020. And we will talk to everyone very, very soon.